When looking across the economy, everything seems to be in shambles. As of Friday, July 1st, this is officially the worst start to a stock market in over 50 years. The question on everyone's mind is, how bad can this really get? In today's video, we dig into the details, looking at one of the most underrated charts in finance, analyzing the possibility of further pain. The big question is lingering in the markets. Will 2022 end as the year we all remember forever as a turning point, or will this go down as one of the most painful declines in America's history, following an unprecedented era where pandemic, war, and political division ushered in a new age of darkness? We start with a simple philosophy. We know that in today's modern economy, a lot of emphasis is placed on the decisions and words of the Federal Reserve. They set rates, and rates are to markets what gravity is to physical matter. This extremely powerful force dictates the direction of overall markets, and investors pivot based on the expectations of what the Fed might do. No one explains this invisible force and its power better than Warren Buffett. Take a listen to this quick clip from 2016, and afterwards, we'll lay out the chart I was talking about earlier.
Do you share any of his sentiment when it comes to worrying about bubbles that could be inflated just by this low interest rate environment?
Well, low interest rates act on asset values like gravity acts on physical matter. And if you had zero interest rates and you knew you were going to have them forever, stocks should sell, 100 times earnings or 200 times earnings. I mean, if your alternative is absolutely zero and it will last forever. So when interest rates were 15% with Volcker, that was an enormous gravitational pull on the value of all assets, not just stocks. Because an investment is something where you lay out money now to get more money later on. And if you can get 15%, it makes the choices way different than if you get zero. So, and we've had low interest rates now for longer than most people expected. And to some extent, it's changed people's expectancy about interest rates.
Okay, so now that we understand the power of interest rates, we can lay out the current market conditions and what this will mean for the future. Obviously, the Federal Reserve has begun to tighten or raise rates. This was done largely because of really high inflation. Prices all over the place have risen at an unprecedented pace. To combat this, what essentially happens is that the government artificially dampens demand through these interest rate hikes along with a softening of QE. So far, they have gotten to a federal funds level or an interest rate level of 1.21%, which historically is barely scratching the surface. Now, despite the fact that this is a tiny rise, the economy seems to be imploding. Interest rates on mortgages have risen to over 5%. The S&P 500 is down 20%, and the Nasdaq is down 30%. We also have plenty of speculative stocks down well over 80%. And this extreme reaction to this tiny raise is an important detail. You see, today's markets are always attempting to predict the Fed's next move, and unfortunately, the Fed isn't really the best player at the table. They're just the whale with the biggest stack, and the hedge funds, algos, and bond traders are the sharks running circles around them. Plenty of professionals are looking at various pieces of data and seeing the obvious. All the big commodities that were responsible for most of this inflation are dropping like a rock. Wheat futures are down nearly 50%, gasoline down 15%, and one of Wall Street's favorite indicators, semiconductors, down over 40%. The 10-year Treasury, which essentially dictates where 30-year mortgage rates are going, is also heavily down on the week. These are signals that the Fed has gone too far, and the market is just going to do the work for them, pushing down while they barely had to budge, moving rates to just 1.21% thus far. Everyone is signaling that the U-turn is next, and instead of pushing rates higher, the Fed will be forced to reverse course and begin cutting. Now, all of this won't happen overnight. In fact, many speculate that the pain is far from over. Semiconductors, to many people, are the epicenter of the economy. They provide us with clues on a wide array of parameters that usually tend to follow the overall theme, and Tim Seymour made this very clear during his segment on CNBC. You can hear him explain the danger here.
And if I look at semiconductors, the underperformance to the S&P in the last, call it 20 days, is about 13%. Again, to an S&P that's been down aggressively. This is how much the semiconductors have underperformed, and it's in stark contrast to the rally in bonds. And obviously, they're the same story. It really is facing the recessionary risks head on. What we've seen in the last 3 days, as referenced with the 10-year, going from 350, we're at 280 on the lows today. Obviously, bonds didn't finish at those low on yields, and they actually rallied back a bit in terms of yields move higher, bonds sold off. But it was really an ugly, ugly day. And we pointed out this week, and I think we're going to continue to point out, it may be okay to see those interest rate sensitive stocks rally, especially mega cap tech stocks on a day like today, and they will carry the market But what I saw today was pretty ugly, and I think the move in the semiconductors is downright scary because that talks about the real epicenter of the economy.
On top of these clear indicators, we have two major problems right now in our face. The consumer, which makes up a large majority of the economy, is faltering. This report by Deloitte shows exactly this. The number of people delaying large purchases in 2022 is growing rapidly. Discretionary spending continues to fall, especially for those in the middle class, and the personal savings rate is nearing an all-time bottom. The slow-moving train wreck is becoming more apparent. Then on the manufacturing side, we have a shocking development. The ISM index, a measure that is considered the most reliable indicator of factory activity, that graph is down to June 2020 levels. By most expert accounts, this index is a leading indicator, meaning it shows where the overall economy and market are headed. Now, putting all of this together, many speculate that the true bottom for the market is much further down. In fact, what they're saying is that if semis are down here and ISM levels are down here, we should, in reality, have an S&P 500 that is around 2,800, which is where it was in May of 2020. This is supported by one of Warren Buffett's two favorite readings, which are still, despite this crazy drop, flashing overvalued. For example, the Buffett indicator is currently at 171%, nearly 35% above the historical average, and the CAPE ratio, which measures earnings relative to the S&P 500, is also flashing red despite this recent drop, indicating that we still may have a long way to go. Now, of course, all of this comes with a massive asterisk. There really is no telling where we go from here, especially given the fact that so many important variables are hanging in the balance. You have a war in Europe that could easily spill over borders and introduce significant energy pressure, especially in the upcoming winter. You also have a Federal Reserve that seems to be behind, reading outdated data, confusing markets and politicians. And finally, you have oil at near record high prices, with inventories all over the world down to record lows. Black gold is the ultimate commodity, pushing up overall prices. Without relief here, inflation may continue to be a problem, and then we have those who claim that even an economic meltdown may not cure rising prices. Either way, massive problems await the US economy, and sneaking around them in the coming year will prove to be the challenge of the decade. There will be plenty to talk about and report on as volatility increases and uncertainty about our future grows. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed it.